Good afternoon, everyone. Thank you so much for joining us today. This is our first sharing session with regards to Labuan IBFC, specifically for Malaysian public listed companies. We hope you enjoy the presentation and we hope you benefit from it. Again, I'd just like to echo Wyman's thanks to all our partners, without which this would not be possible. So next slide, please. Right. So actually, it's very interesting when you look at Labuan IBFC and how we've grown over the last 30 years, that Labuan IBFC was originally and started off catering to Malaysian corporates looking to expand beyond Malaysian shores and to benefit. So for them to benefit from a wholesale financial intermediation center. Now, 30 years from there, where are we, right? We are still an international business and financial center. We are still very well regulated, but the landscape of tax has changed so dramatically that, you know, a lot of people are asking whether a center like Labuan is viable, right? So this is really the crux of our conversation today. And we will discuss this later in the panel, right? But what we like to think is that with the tax efficient substance enabling mid-shore proposition that we offer, Labuan IBFC is still a very viable intermediation center for Malaysian public listed companies, right? So what we have is a well-balanced legal and regulatory framework, proportionality in regulatory stance. I think a lot of people need to understand that Labuan, being a wholesale center, is allowed to, well, we operate actually in a very wholesale environment, which allows for a lot of innovation and unique structures that we offer. Yeah. Robust governing legislation passed by the Malaysian Parliament. This is another question that we get asked a lot when we go out there and talk about Labuan. Is really, where does Labuan sit within the Malaysian structure, right? So we understand that Labuan offers internationalization and all the rest of it, but within the Malaysian structure, where does Labuan sit, right? What I'd like to really share and make clear today is that Labuan ranks, and the next slide will show, but Labuan actually ranks as a statutory body under the Ministry of Finance of Malaysia, and all the laws that regulate Labuan, that provide for all the structures and the solutions that you will enjoy in Labuan, is actually passed by passed by legislation it's provided, excuse me, by legislation that's passed by the Malaysian Parliament. I think that is a very important element for everyone to understand where it sits within the Malaysian financial ecosystem, right? And what's also important to understand is that from an anti-money laundering point of view and terrorism financing point of view, Labuan IBFC adheres to Malaysia's national legislation with regards to that. So definitely there's no arbitrage, whether it be between Labuan and onshore Malaysia. Yeah. And again, there'll be another slide that discusses that. Sorry, next slide. Yeah. Thank you. Okay, so just to expound that earlier fact about where Labuan FSA, which is our regulator, sits within the larger ecosystem of financial service or financial business service providers within Malaysia. So as you can see, it is a statutory body under the purview of the Malaysian Finance Ministry, and it sits as part of the larger Malaysian financial ecosystem, right? That needs to be made very clear. Next, please. So a lot of people look at us and say, oh, yes, what does this concept of midshore really mean, right? And how is it, what is midshore? So we understand offshore and everything that it brings. We understand onshore, but what is midshore? And really midshore just alludes to the fact that we are in a very unique space because we are well regulated. Being part of Malaysia, what I really need for you to take away from this slide is that Labuan sits in the middle, right, of the pull and the push of wanting to be an innovative, cutting edge wholesale intermediation and financial center, and at the same time adhering to all the international standards of regulation and supervision, best practices that Malaysia as a country adheres to. So what you have is a natural pull and push that then helps to curate the Labuan offering, creating a very safe harbor for businesses, especially in this time of change and uncertainty. I think the benefit of having a single regulator, right? So what's also important to understand is that the single regulator via Labuan FSA acts as the body that regulates everything that you would have onshore. So for example, the Companies Commission of Malaysia and the Companies Commission, if you had an equal body in Labuan, sits within Labuan FSA. The only other competent authority that has jurisdiction within Labuan FSA is the Malaysian revenue, which is the inland revenue of Malaysia. And the inland revenue of Malaysia, their remit is to ensure that the taxation system of Labuan remains well regulated and structured, right? Next slide, please. Asma, you raised a hand. I think maybe what we can do is take your question at the panel later, if you don't mind, because I've got another three presenters who are keen to share a bit more after me. But yes, thank you for your question, Asma. And what we'll do is we'll take it at the panel in a minute. Yeah, thank you. So remember, I spoke about the Parliament of Malaysia passing all the acts that govern Labuan, that create the unique solutions, and give powers to the regulator. These are the comprehensive suite of legislation that govern Labuan. So if you look at Labuan, Labuan Island, and if you imagine these little three balls as clouds of legislation that hover on top of the island, you'll see that you have legislation that is enacted and supervised by the Inland Revenue Board. You have acts of general application, and these are the Anti-Money Laundering Acts that I mentioned earlier, the Anti-Corruption Act, the Anti-Financial Crime Center Act, the BNM Foreign Exchange Notices. These are universal national acts that govern everyone in Malaysia, including those that operate in Labuan. Then you have those acts that are governed, that are operated and legislated via Labuan, legislated by the Malaysian government and regulated and overseen by Labuan FSA, and these are the list of acts. Now, what is important to remember is that while these three balls of the clouds of acts that sit on top of Labuan Island, right, you have still the onshore domestic that sits on Labuan Island. So for example, if you go to a bank in Labuan, chances are you will go either to the same named bank, a branded bank, whatever it may be, right? But you could go to an onshore version of it, and you could go to a midshore Labuan international version of it, right? So this is what's important to remember. If you just think of it as two systems running parallel on Labuan Island, this is the best way of understanding it. One is catered to more international business, definitely international business. One that's catered to just generally the onshore business, which is exactly the same as what you have in Kuala Lumpur and Peninsular Malaysia and everywhere else in Malaysia. Yeah. Next slide, please. So what do these acts create? What is the aim of having these acts? And what it does is it creates a complete ecosystem of solutions and structures that then users like Malaysian public listed companies can avail themselves to. So this ranges everything from international business companies, which are IBCs, to insurance entities, to leasing, which also a lot of public listed companies use, wealth management solutions catered to ultra high net worth individuals, banking, obviously, and then you have our trust companies, so basically our company secretaries like Tricor, what we like to call TCSPs or trust and corporate service providers, and then we also have a burgeoning digital market in Labuan. So just remember that the acts are essential because the acts create the ecosystem that the regulator then regulates. Yeah. Next, please. Oh, sorry. Before I move on, there's also the option, right? So we have a digital, everything within Labuan can be digitalized, and everything within Labuan can also have an Islamic version aside from the conventional version. Yeah. Next slide, please. So what I'd like to talk about a little bit is this fiscal structure, but really, you know, it's just important to understand that fiscally or from a tax point of view, we are neutral, right? We are a neutral tax environment that allows for the facilitation, the effective facilitation of business. I'm not going to go through this slide because I have 3 tax experts, coming on after me, there's no point for me to talk about this because it's very clear already, and this is something that they go through, I'm sure. But what's important to understand is Labuan has access to Malaysia's double taxation agreements. There's 100% ownership, foreign ownership that's available in Labuan, and there's exemptions on withholding tax on dividends, interest, royalty, service fees, lease payments, and I believe foreign source income. Yeah, next please. And also just to go back to the tax element, I believe recently in the last 2 days there was a Gazette order that talked a little bit more about that gave further clarification with regards to substance requirements, tax substance, economic substance requirements in Labuan, and I'm sure we will talk about it in the panel, so stay tuned for that later. Yeah, this is just a show-off slide to show you our international brands in our key verticals, whether it be insurance and captives, banks, leasing, LITCs, and digital financial services. Next slide, please. Aside from that show-off slide, what I'd also like to talk about is the fact that, it's important to understand that the Labuan financial ecosystem is very deep and wide. Yeah, I believe our Director General was quoted as saying recently that by the end of the year, we expect to be licensing 900 licensed financial intermediaries in Labuan, and that is no mean feat. So 900 licensed intermediaries is the size of our financial ecosystem, if you will. So what I'd like to really reiterate here is that this is not a small jurisdiction. It's not a shallow jurisdiction necessarily, and it's the interest that we've had over the last 5 years or so has been exponential, even during COVID times. Now, I wanted to talk about this particular slide because in a lot of instances, we get a lot of questions as to whether Labuan is a tax haven. Is it safe to operate in Labuan? How will Labuan be seen? What is the perception of having a Labuan company? Or what is the perception of using a Labuan vehicle, for example? Or even what is the perception of banking in Labuan, as basic as that, or having a Labuan company, for example, to facilitate your foreign dealings, right? What we'd like to say here, and this slide will show and tries to evidence the facts of why we are not a tax haven, why we are not an offshore box standard offshore center, right? So a typical, on your left side here, you have what we call typical tax haven characteristics. And on the right side, you have our Labuan's characteristics, our unique characteristics. So typical tax haven characteristics provide for no or nominal tax. Labuan has never, except for investment holding vehicles, Labuan structures and Labuan companies are taxable, right? And now with substance requirements that I think Dr. Veerinda will be talking about, there is a very clear need to have mind and management, as evidenced by the Gazette that was recently introduced, mind and management and actual operational activities in Labuan, right? In order to enjoy the preferential tax rate. But what personally I have seen over the years representing Labuan is that there has been a very gradual but significant shift as to why users use structures in Labuan. It's not necessarily just about tax anymore. There are very unique structures in Labuan provided by the Acts of Parliament, created by these Acts of Parliament, these unique structures that find a natural home within a wholesale financial intermediation center. And so whilst tax is a key consideration, because obviously tax is going to eat into any bottom line, right? But while tax is still a key consideration, what is paramount is really the availability and the usability of these very unique structures. Now, I'm sure Catherine, who will be speaking after me, will be talking about some of these structures as well, yeah? Generally, tax havens don't comply to international standards and minimal enforcement. Labuan IBFC, on the other hand, is largely compliant as assessed by a lot of multilateral entities. What's important to remember is that when I say largely compliant, it doesn't mean we're not compliant. Malaysia, Labuan IBFC is assessed as part of Malaysia. So as part of the Malaysian ecosystem, when multilateral organizations and entities come in to assess the health of our system, they assess Malaysia collectively, they assess Labuan collectively as Malaysia. So if Malaysia is largely compliant, that will be the ranking that Labuan will enjoy. If Malaysia is fully compliant, that also will be the ranking that Labuan will enjoy. There is no segregation here with regards to this, yeah? So lack of transparency, everything in Labuan is transparent. We are a member of BEPS, an inclusive framework. No or unwillingness to exchange information. We have signed 23 MOUs. We have a wide network of tax treaties. So remember, Malaysia's tax treaty also applies to Labuan, most of them. And in addition, the regulator has 23 MOUs that they have signed where there's regulatory to regulatory exchange of information, right? Absence of substance. So complete pass-through, that doesn't happen in Labuan at all, right? Next slide, please. So this is just a wrap-up slide. This is my last slide, and I've been told to wrap up. So why Labuan IBFC? It speaks for itself. I think what we have in Labuan IBFC is a very complete ecosystem of financial intermediation and business structures that are unique, which Malaysian entities should refresh themselves with in order to really take this benefit, use Labuan to their benefit, which is key in any expansion growth for any Malaysian public listed companies. And with that, I'd like to wrap up. I'd love to take your questions and at the panel later, but I'll give way to my other speakers now. Thank you very much for your attention.
Thank you, Yuan, and I thank Farah as well, because I think Farah has done the marketing part of it in terms of giving you the benefits of Labuan and all that. And I think that is a very good summation. And before I go into my session is really about just giving you an update on international tax developments, in particular with regard to the global aspects. And there is this mention of BEPS and so on and so forth. I'll cover that. And I just wanted to, in the context of that, to remind everyone that when Labuan was created in the 1990s, it was seen as being very similar to the various islands of the world, which also have similar features. International offshore financial centers, which were originally called tax havens, and then they became known as international offshore financial centers, or IOFCs. The concerns at those times were all about that operating in this particular locations is all about secrecy, is all about very little rules, very little regulation, and you are free to do what you want. So that was the perceptions. And that's why the name tax havens came in those old days. And then you find that the global community decided to take a little bit more interest in this and try to push for what we consider as more rules, more substance. And that's how we came out with this Forum for Harmful Tax Practices that some of you may have heard about. And as a result of that, the global community, in particular the OECD, requested this island locations of known as IOFCs to perhaps add more substance. It's not about increasing our tax rates. It's about using those places, those locations, for commercial transactions or other transactions which have got some substance. And that's why in Labuan in the past few years, we've had these changes that have come about, quite a lot of changes. And some were confusing initially, some were very clear, and some I think rectified as late as yesterday, I suppose, when we got the new Gazette Order guidelines. Maybe one or two things are still a bit outstanding, right? So we are therefore in tune with global developments. So I think that's where Labuan's evolution in terms of perception in the early days to having substance, commercial realities to your transactions. And then later we'll talk about what do these global developments also mean for Labuan. In the panel, we can perhaps address whatever issues there may be. So let's move on to the next slide, which, okay, this is the global tax developments that I will touch on. And just to have a quick overview and impact, and perhaps impact on Labuan as well. Next. Just click one more, please. Just get all the pictures on the slides on. Yes. Now, this is just giving you the backdrop as to this BEPS initiative, and that's called BEPS for short. It is base erosion and profit shifting. And this was the package that came out from the OECD a few years ago, 2015. And it had 15 action plans. And the whole idea of BEPS, as many of you would realize, was actually to look at trying to curtail what they considered as evasion or what they considered as aggressive tax planning, particularly by multinational corporations, which are represented internationally in many countries, wherever they operate through subsidiaries and so on and so forth. And the idea was trying to see how we can try to have some rules, some regulations, which are similar across the world. There's no such thing as total similarity, but at least guidance to what we can do. And these were the 15 action steps that were mentioned. The first one on the digital economy is the one which didn't really, wasn't really taking shape until lately, when we have this Pillar 1 and Pillar 2 initiative, which I'm going to cover on. So this is just to be aware that we, in most cases, some of these don't apply to us, but some of this has already been done. And I want to draw one attention to number 13, which was the transfer pricing documentation. Now, Labuan now has got these rules as well to require Labuan companies, where necessary, to have transfer pricing documentation. We never had that before. And later we'll have a discussion on that as well. So let's move to the next slide. Just click, yeah, might as well put all in, yes. In the interest of time, better to see the whole picture rather than part of the picture. This is what I showed you earlier on BEPS, was the BEPS 1.0. And this is now BEPS 2.0, which just was, I think, articulated this year. And we call it the Pillar 1 and Pillar 2 issues. And just to give you an idea of timeline, I think 2015 BEPS first came about. And then you formed the inclusive framework with all the countries that were looking into this and eventually agreeing to apply the BEPS initiatives. And then in 2017 and 2020, they discussed that first action step, which is the tax challenges of the digitalization of the economy. The feeling here was that there are some very large multinationals in the world, the technology companies as well, who may be able to do things across borders without actually being in a particular location or venue. So that's why this came up as the blueprint for the two-pillar solution. And then you move on in July this year, 130 countries of the inclusive framework have agreed to join issued a statement on the two-pillar solution and so on, and is moving along. Interesting suggestions, but again, subject to many, many conditions. And it also depends on how the US sees this and approves this, because they are a key party in all this, and the target dates and so on. And we actually only expect this all to materialize perhaps by 2023 in terms of application of whatever I'm going to talk to you about. Let's move to the next slide. Now, so as mentioned, BEPS 1.0 was this project and meant to address many challenges, but Action 1 had difficulties, so we moved to BEPS 2.0, and this is to provide a consensus-based long-term solution. Now, remember one thing, this doesn't really impact all of us. This applies to the very large multinationals across the world. And the action step or the solution that is being proposed is in two pillars. Why is this being proposed? The whole idea was to try to ensure some element of fairness and equity in tax systems across the world. And therefore, the other aspect of this was because of new business models, technology, the gig economy, and everything now being easily done without actually having a presence in a location through technology, means that our international tax framework also needs to be modified to take into account of these developments. Next slide, please. Yes, so this pillar one that is being the focus of especially multinationals focuses on what we call the nexus rules and the profit allocation aspects of it. And what does this mean? I will not go into too much of detail, just to give you the bigger picture. The idea here was to allocate a greater share of what we call residual profits of large multinationals to market jurisdictions. Market jurisdictions are those where consumers are, where sales are made. And the idea of trying to allocate a share of the profits was by using a nexus rule without reference to physical presence. Remember, many of these multinationals operate in our countries without actually having a subsidiary in our countries. And therefore, the question is, shouldn't those countries where you have consumers buying these products or services online and so on, shouldn't those countries receive a little bit of tax as well? So that's what the focus was. But the issue here is that what if there are differences of opinion between the various countries where these multinationals operate? Who arbitrates? Who decides is a question. And what if there are disputes between countries? So that's a question mark that still exists. And also, last point here is that this only applies to multinational groups that have more than 20 billion euros in terms of global turnover. And profit also must be above 10% based on the profit before tax over total revenue. So it's only those who cross this barrier, and then you look at the residual profits above the 10%, and then there's an allocation of these profits to the relevant market jurisdictions. And at our initial evaluation, we don't think any of Malaysian corporate groups will fall into this particular category for the time being. Next, please. This now is the BEPS Pillar 2 initiative. Pillar 2 is a bit more interesting because it talks about a minimum, a global minimum tax rate. So this is to focus on other challenges faced globally so that we can ensure that the large companies that operate in many countries around the world pay a minimum level of tax. Now, this is actually very interesting. And unfortunately, I think you all know by now, if you've read it or if you haven't, then this is where you heard it. It doesn't apply to every entity. As you can see in the third bullet point, it only applies to multinationals which meet or exceeds the annual gross revenue of 750 million euros. So only those companies will be subject to this, which means that you're trying to look at ensuring that there is a global minimum tax that they are paying, combining all their subsidiaries around the world, looking at the tax exposure in each country, combining it and seeing them, making sure they suffer an average tax rate or minimum of 15%. So it does tell you that if you were operating in a jurisdiction which has a zero tax rate or lower tax rate than 15, you may have to do a top up of the tax. The interesting thing about this is that the top up of the tax actually happens in the parent company's jurisdiction. That means where the country where the parent company is located. Of course, I do think that maybe the relevant countries where the subsidiary operates could also want a share of this. And perhaps we should change our laws to allow us to collect that little top up that we're talking about. For example, if you were paying effectively a tax rate of 5% in Malaysia, and then you are qualified as an MNC under this category, then the 10% additional tax on this amount of revenue in Malaysia, or rather amount of profits, could be something that Malaysia should be imposing. Right now, it's not clear. It actually says initially that it is the parent company's headquarters which will collect this. And this may be effective in SS 2023. Question that arises is, what is the future of tax incentives? And the initial reaction of many was that maybe tax incentives may no longer be very effective. In particular, if you're trying to attract these very large multinationals. So if everybody has to pay a minimum global tax rate of 15%, then what's the point of giving them a zero tax rate to attract them to come to your country? Because they'll still end up having to pay something elsewhere. So that's where the challenge is. Next slide. And so again, the MNCs will enjoy tax incentives and a low effective tax rate in Malaysia. What does that mean? There will be a top up in their home jurisdiction. And therefore, at the end of the day, if you look at your whole group, you look at an effective tax rate, you find that the advantage of having a tax incentive, a low tax rate, is neutralized at the group level. So Malaysia in this context should be relooking at its approach to tax incentives, perhaps. Maybe you have two tiers in terms of no zero tax or low tax rate for this large multinationals, and perhaps a second tier of operate businesses. You could still do that. I'm not so sure. This is work to be looked at. You need to perhaps improve all your other factors, your other attractions, your other selling points, your other enablers, rather than just focusing on tax. And that's why I think many countries who have agreed to this will start looking at the non-tax incentives, some form of assistance, being business friendly, and having all the other aspects in terms of effective labor, efficient labor, and so on. Next. The next thing I wanted to talk about is, can we click on all the 6 items? This is the EU watch list that Malaysia was put on recently. And this is linked to Malaysia's budget that came out recently as well. And so this was about countries that receive passive foreign source income, such as dividends, interest, and royalties. It was aimed at that because the idea of the EU was they do not want certain types of income to be not taxable in any jurisdiction. So they want to avoid global or rather double non-taxation. So that was the focus. And Malaysia suddenly reacted to say, we will remove our exemption of tax on all foreign income coming into Malaysia. Remember this, that we have this exemption. We have a territorial system. And this is the system which is exactly the same as Hong Kong. We are required to commit to the EU's request by 31st December. And once this is done, Malaysia will be taken off from the grey list. And the reaction of Malaysia was very swift, which is quite rare, because usually we take our time, but this time we went very fast to suggest a change in the law. And many of us think it's a knee-jerk reaction because of the grey list, but we also think it's a reaction from the authorities to try to collect more taxes. And then my suggestion, and many others who have suggested, is why don't we consider the way Hong Kong responded to their inclusion by saying that we will defend our territorial system, but we will change the law to allow some substance requirements and tax certain type of income that perhaps will may benefit from global non-taxation. So let's avoid that. So that's just to give you an idea of what has happened recently, and perhaps we can talk more later in the question and answer. And the last slide, yes. So the way forward really is about the fact that the government needs to, needs to perhaps look at the government tax policymakers, needs to consult everybody. And sometimes we find that not everybody is consulted. We need a clear position on the matter in terms of the EU grey list. We therefore may need to have reform of the tax system, which is currently in progress. And again, a reminder to everybody, it does not mean just because you're pillar 1, pillar 2, and the gray list, that we cannot provide low tax rates or tax incentives. So in the context of Labuan giving a 3% tax rate or even nil tax rate for holding entities is still fine. It is not something prohibited. And but whatever it is, we need to watch the space in terms of managing all our activities. Thank you very much for this, and I pass it back to the MC.
Good afternoon, everyone. When we talk about Labuan, like what Farah said in the earlier presentation, there are many questions asked and debates from the Malaysian market. Some may remember it as a low tax jurisdiction. Some may think it is just useful for out businesses and for foreign investors. Malaysian companies are not benefits from it, thus Labuan was not relevant. And some of you maybe have heard that Labuan recently changed its tax law, and therefore conclude that Labuan constantly changes its law. But are all these views true? So, well, Tricor, Trustco Labuan has been doing the business in Labuan for more than 18 years. And I can testify that not this view all true. So my session today will be very much share on some possible structure that use Labuan vehicle for your corporate exercise. I would like to clarify here, not all businesses or industry are suitable to use Labuan as part of your corporate planning. However, I hope you can get some ideas from my sharings today. So to clear everyone's doubts from all why Labuan, so many changes, perhaps I need to have a quick history review about Labuan so that you know where are we come from. Okay, so hope you are not bored history, okay? In 1990, Labuan was declared as an international offshore financial center. So in 1996, the Labuan Offshore Financial Services Authority was established under the Offshore Financial Services Authority Act. At that time, people call Labuan Authority LOFSA. Even until today, people still call Labuan Authority LOFSA. So to be an offshore financial center at that time, it is not permissible to deal with the domestic businesses at that time. And Labuan IBFC was formed in 2008 as a separate marketing arm to promote Labuan. So with the rollout of the refresh holistic legislation in 2010, Labuan was placed on the white list of the OECD. So when offshore center received bad press, talk about tax haven, and very quick, Labuan IBFC realized they needed a change. So in 2013, Labuan IBFC repositioned itself as a midshore center. So incorporating elements of both onshore and offshore legislation. So that's why just now Farah said it's a midshore. So it opened its door for Malaysians to facilitate their businesses through Labuan. So further to that, the Labuan Authority rebranded itself from LOFSA to LFSA. So we do not call them LOFSA anymore. We call them LFSA by deleting the O, means offshore. Okay. So in 2019, two set of law has been changed. Okay, has been amended, not changed, but amended. Labuan legislation entities having trading activities no longer have the option to pay the flat tax of 20,000 ringgit. This means that all Labuan entities which have approved Labuan trading activities will have to comply with the economic substance requirements in order to tax for the tax rate of 3% on their chargeable profit. There are significant changes for Labuan companies. So under the revised Labata, which took effect from 1st January 2019, some substance requirements means to having the substance requirement, meaning that a Labuan entity must have an adequate number of full-time employees and annual operating expenditure. Although there are changes in tax rules and definitions of business activities, overall, I think Labuan IBFC still remain attractive as a financial business center in Asia. So back to our topic today. How can we use Labuan as a vehicle to fit into our business structure? Many use Labuan previously, especially Malaysian company. They use Labuan for leasing and debt financing structure, such as bond and sukuk. So I will not go into this topic as most of us already very familiar with. Today, I will share with you few other structures that are increasing in demand during the pandemic. Maybe you are in the midst of negotiating with potential investor to invest in some project, and you are wondering how best to manage the share structure and your voting rights. So as such, today I will share with you the fundraising structure for the investment purposes. And next, you may also think about how to optimize our costs, because during the pandemic, I think fundraising and podcasting is two hot topic that we are looking at. So captive insurance can be an option for you, especially for those companies that are currently paying high insurance premiums annually, but have a low claim. Okay, so on the other hand, I understand some may have some of you may under the family businesses, and a very real issue during the time of pandemic is the matter of succession planning and protection for our loved one. So have you start looking for suitable vehicle in order to manage your wealth? So with my limited sharing times today, I will share with you a few structures for your consideration. Okay. Firstly, let us talk about the fundraising vehicle that continue to grow in Labuan IBFC for the past few years. Most of the fundraising vehicle they use using a familiar legal structures such as limited partnerships or limited liability partnerships. The credit token license is also now offered as a unique financial license, which focuses on fintech companies that tap on foreign investment and funds. Labuan private funds allow foreign investors to invest any domestic and international projects. It can be designed in a ringgit and foreign currency at the same time. So in 1st January 2014, the Labuan LFSA issued guidelines on the establishment of Labuan mutual funds, including Islamic mutual funds. So mutual funds in Labuan are allowed to be structured through Labuan company, partnership, protected sale company, or unit trust. So let me quickly share with you the potential of using Labuan vehicle for corporate exercise. So firstly, we will look into partnership structure. Not to be confused between the LP and LLP, because Labuan have two types of partnership, limited partnership and also a limited liability partnership, although they are almost alike functionally. So an LP is a partnership with two partners, a general partner and at least one limited partner. The general partner manages the operation, while the limited partner only contributes money to the business. In addition, the general partner is personally responsible for the liability of the LP, and he shall have all rights and powers of management control, while the limited partner is protected from his personal liability, but however, he can lose his financial investment in the LP. So of course, the limited partners have no voting rights and no control over the operation of the LP. Here also, I will share with you the limited liability partnership, the LLP, which LLP comprises two or more partners who operate or manage the business together. Therefore, all the partners share liabilities, but in a limited way. So professional service providers such as law firms, accounting firms, and financial services firms often use LLP. A Labuan LLP will be protected from liabilities or partnership obligations from the misconduct of another partner. Okay, this is because partners of the LLP are not liable for the negligence of or malpractice claim against the other partners. Okay, so let's look at the mutual fund structure for private projects. The Labuan private fund is suitable for those who intend to extend the offer to a close group of investors and not the general public. Okay, so this is very important. It has to be a close group of investors and not the general public. So there is no requirement for fund manager or special license for it. A Labuan private fund company can carry on its business through a Labuan company. So by given a notice in writing of its scope and the nature of its business to Labuan FSA. The notification lodged shall be accompanied with an information memorandum, we call it IM, or prospectus through a Labuan trust company. The only conditions for this Labuan private fund is the two that you can see at the bottom. More than 50 investors, the initial individual investment must more than $500,000 ringgit or the equivalent in any foreign currency. Where there are fewer than 50 investors, their initial investment shall be more than 250,000 ringgit or equivalent in any foreign currency. So the chart above shows how a Labuan company allows foreign funds to invest in a Malaysian project. And the dividends are paid to the Labuan shareholders and its investor. So the investor hold preference share of the Labuan company, therefore they have no voting rights. Okay, so next, I would like to talk more about the credit token license in Labuan. So I know some of you maybe newly heard about it. It is quite new to some of you. In line with the increasing interest of Bitcoin and blockchains, this is a very hot topic nowadays. People talk about blockchain technologies and coins. So Labuan IBFC is one of the pioneer among other jurisdictions to issue fintech license back in 2017. And this credit token license actually is already been with Labuan for a long time. But because of the changes of the improving of the technologies, so Labuan are now become a digital friendly jurisdiction. So Labuan IBFC have developed a wide range of products from digital banking and insurtech to being an intermediary such as a robo-advisory, digital assets exchanges, crypto trading platforms, tokenizing license and e-payment systems. So as of December 2020, Labuan FSA has approved 62 digital services operators, including 3 digital banks, 2 digital securities exchanges, 25 crypto trading platforms, and many others. Okay, so currently there are 12 approved credit token licenses issued by LFSA, some of which are Tricor clients too. So because of the overwhelming encouragement from the authority, so the credit token license, how we can use it. So most license holder issue digital tokens in order to create a blockchain ecosystem to facilitate the use of digital assets. This could be related to real estate investment or the purchase of goods and services provided by participating merchants. Tricor has experience structuring this type of business, so we are able to provide you a complete solution with Labuan mixture approach. So talk to our consultant if you are looking at tokenizing your business through Labuan. Because Labuan IBFC apply a high standard of compliances and corporate governance. So for example, the lately released digital governance frameworks help the financial operators mitigate their cybersecurity risk. So within Tricor Group, we have another business arm called Tricor Excel Asia. They are the expertise in corporate governance. So if you need any internal audit services, get analysis for your current policies or policy drafting services, you can always reach out to them. So this is very important for us to help you to comply with the legislation. Okay, next, we will go to the captive. So we all understand how insurance work by pulling together the resources of a large number of people having a similar risk. So insurer can only access the pool of money through a claim. So in a simplest form, a captive is a wholly owned subsidiary created to provide insurance to its non-insurance parent company. Captives are essentially a form of self-insurance, whereby the insurer is wholly owned by the insured. So they are typically established to meet the unique risk management needs of the owner or members. So let's look at simple diagrams here. On some captive, how captive work compared to the traditional insurance structure. Traditionally, a business pay insurance premium to an insurance company every year. So if there is a claim, the business gets paid and covered. Basically, if there is no claim that year, the premium becomes part of the business expenses. So with the captive, the premium goes to the captive subsidiary within the group. Similarly, the business gets claim reimbursement. Should there be a minimum claim in any 1 year, the premium paid would be the profit of the subsidiary captive company and return to the parent company as a dividend. So as an illustration, please look at this diagram. You can see when you pay a premium, the insurance company makes profit from your premium. I'm sorry about the participants who are from the insurance, but this is where the captives work, okay? So, but the captive insurance setup, you save the premium as the money paid is recycled in the yearly protection, okay? So, there are many concepts and structures for a Labuan captive insurance, but not all businesses are suitable again for captive insurance. So please talk to our consultant or the underwriting insurance manager in Labuan. We can help you to assess your business and advise further. Labuan IBFC had won the Best Asia Domicile Award for the 3 years running at the APAC Captive Review Awards. Both Singapore and Hong Kong were also shortlisted in the same category, but we outbid them. Labuan IBFC has demonstrated the highest level of excellence over the past year, and therefore we won the award. Furthermore, Labuan IBFC also the winner for the International Captive Domicile of 2021 at the European Captive Review Awards held in Luxembourg 2 weeks ago. So well done to the team. Well done, Farah. So no doubts that Labuan is the best choice for the captive insurance program. As of today, Labuan IBFC is currently home for more than 220 insurance and risk management license. All right, so I think I have not much time left. So let us quickly move on. Finally, I would want to share with you our star products, another high demand offering from Labuan. And that is the only one available in Asia, Labuan Private Foundation. So today I will not talk about trust as a wealth planning structure because we're all familiar about trust. Some of you may even have started to use trust as your succession planning vehicle. Besides the trust, are you aware of the benefit of a Labuan Private Foundation? In the last 2 decades, more than 20 common law jurisdictions have adopted the private foundation laws, which introduced the civil law entity into a common law world. So Labuan is one of them. So it is not surprising if you are not aware of Labuan Private Foundation, as the Labuan Foundation Act 2010 is only 11 years old. So many people think that only the super wealthy will set up a foundation. So today I would like to share with you a different view. A Labuan Private Foundation is a registered corporate body with a separate legal personality. So basically, it is a hybrid of a combination of a company with a trust. So this is the ability of control its management and cost maintenance with a similar like a company, but it gives similar protection as a trust. Therefore, Labuan Foundations is flexible, cost-effective, and give 100% control to the founder. Okay, so let me put in another way with a story, since we all love story. So story time. Okay, Mr. and Mrs. Sand were the founders of FGH company. So when the company was listed 10 years ago, they decided to use a Sdn Bhd as their family investment holding company to hold their PLC shares. So Mr. Tan and Mrs. Tan have 2 children, Jason and Jenny. They thought of passing all their shares and wealth to them. So they transferred to both children majority of shares in the investment company and also encouraged them to work in the company. So at that time, Jason and Jenny were young and in their early 20s. 10 years later, both of them are married and have their own family. So things seems okay until Mr. Tan passed away suddenly of COVID last year. Early this year, Jenny told her husband that, Jenny told her brother that she wished to sell off her investment company shares to fund her husband's business. So Jason wanted to buy the shares from her, but Jenny refused because she could get a better offer outside. Seems familiar, huh? So always, sorry, the slide. Let me go back. Okay. So seems familiar with these dramatic happenings. So meanwhile, Jason himself was facing marriage problems, and his wife was claiming half of his company shares. Okay, should Jenny be successful in selling her portion and Jason divorce and give half of his share to his wife, ex-wife, the Tan family will lose majority control in the investment company and also the PLC. So poor Mrs. Tan felt helpless, and he feels everything is not the same since her husband died. So she is uncertain about her future with limited dividend income now. So this is the story about Mr. and Mrs. Tan family. So let us look at another family, Mr. Wong family. So Mr. Wong is the majority shareholders of another PLC. He has 3 children from 2 wives. All his kids from his ex-wife and current wife are not on talking terms and are not interested in his business also. He wished to distribute his shares to his 3 children equally and hope they live in harmony forever. So sounds like good, happy ending, but we know that it is very difficult. So same as Mr. Wong. So he is seeking a suitable vehicle for his family because he knows that no way that his 3 children can live harmony forever after he died. So after a few rounds of studying and succession, Mr. Wong decided to use the Labuan Private Foundation structure. So Mr. Wong endowed his PLC shares to the Labuan Foundation, where he remained as a sole founder with full control rights. Beneficiary is of his foundations are Mrs. Wong, the 3 children, and himself. He set up the Wong Family Governance and Foundation Charter and Articles. In the Charter and Articles, Mr. Wong's wishes was spelled out. He restricts the sale of PLC shares for the next 20 years, unless certain criteria are met. So he proceeds to whole family gathering every year to bring his 3 children and their families together for better bonding and discuss the family future together. So Mr. Wong is making effort to balance the family dynamics during his lifetime. The foundation plays an important role in protecting his PLC shares from being diluted and avoiding infighting among his children later. Concurrently, for his business, he plans for its succession by appointing a professional CEO to run the company. He also prepares his senior management staff by allocating some shares via an ESOP to his senior staff. So with this arrangement, Mr. Wong has planned for the company to continue growing with sustainable dividends income for the benefit of the foundations, which can provide for his grandchildren's welfare and needs and to fund his great-grandchildren's education. So, let us compare the decisions of Mr. Tan and Mr. Wong. So both of them are successful businessmen and both love their children very much. The difference is the holding vehicle used by them to hold the PLC shares, which is a normal private company versus a Labuan Foundation. As you can see, the idea to hold shares via a vehicle is the same, but the protection and governance of these 2 vehicles are very much different. So as a result, it has differentiated from the risk of dilution versus control, the claim versus protection, and most importantly, avoiding family tussle with the family governance. So rest assured, the last thing we want on earth is to get into family fighting, argument, and even some brings their siblings to court. We want to avoid all this dramatic story and publicities like the Lee's family in Singapore a few years back, right? So we plan when we still in control. We plan and provide direction for our loved one so that the next generation will not feel lost and confused with our leftover. So this is very important. Okay, so feel free to contact us if you wish to understand more about using Labuan structure in both corporate and family planning. I hope today I can give you some idea about how we can use Labuan vehicle for our corporate exercise and also for our wealth planning.
So thanks for all the participants who are still staying with us. A very good evening, I guess. We're running a bit behind, and I assure you my session is not as interesting as Mr. Wong and family. So without further ado, just let me very quickly give you an update. So the purpose of this short update is really to look at transfer pricing requirements from a Labuan perspective. Next slide. Okay, so I think earlier Farah had kindly set out the the three bubbles or clouds, right, for which Labuan's legislation lies, right? So here we are looking at the transfer pricing requirement from a Labuan perspective that is contained under the Labuan Business Activity Tax Act, right? So which I call for short LBATA, right? And this introduction of transfer pricing provisions in the Labuan Tax Act was introduced in 2019. It took effect for year of assessment 2020, right? So that would be for Labuan companies, that would be the 2019 financial year, right? So that also ties in with what Dr. Veerinder was mentioning about, the BAPS action plan. So this is part and parcel of Malaysia's requirement to meet those BAPS action plan requirements and therefore introduce specific provisions on transfer pricing, right? So what exactly is transfer pricing and what is this provision all about? Okay, it basically sets out that any Labuan company, if you enter into a transaction with a related person, or in our legal jargon, we call them associated persons, for acquisition or supply of property or services, that person must apply and they must determine an arm's length price, right? So what exactly is that arm's length price? The arm's length price is really the market price. What would be a similar price if that Labuan company had entered into a transaction with a third party, a party that is not related to them, okay? And what are the powers under Section 17D, right? So the Director General of Inland Revenue, he is empowered, right? So the DG is empowered to make an adjustment to that transfer price if he feels that the price that has been applied does not meet the arm's length requirement. Okay, so here the Director General, the DG, he will then determine a new chargeable profit for that Labuan company. Next slide. So just a recap on the arm's length principle, it's a very simple concept, okay, simple concept, where we say that, as far as the pricing is concerned between a Labuan Co and the related party that they transact with, it needs to reflect the market price, okay, in a comparable transaction. Next slide. So as far as the Labuan laws are concerned, they've also enacted certain definitions, right, under the transfer pricing provision. So we talk about who's an associated person. In my presentation, I also refer to them as related parties, right? So here we are looking at persons, one of whom has control over the other, and all persons who are controlled by some other person, right? A third person. So you have a holding company, which is controlling these two related companies. Now, there's also under the Section 17C in LABATA that talks about definition of control, meaning that is controlled by way of shares, right? So we're looking at the majority control over shares or voting rights of the company. So we're looking at more than 50% control. All right, so that's where we started out. Okay, now as you know, there were a lot of refinement to the Labuan Tax Act. So every year you see changes, and in fact recently we saw a new regulation that was issued. I'll come back to that. So perhaps I can move on to my next slide first. Okay. The one before. Okay, so in 2020, there was another change in the Labuan provisions for transfer pricing, which was to enlarge the definition of control. All right, so here there's a whole lot of words. I'm just going to move to the next slide and explain to you what I mean. All right, so how they had so-called widened the definition of control is that now, remember earlier our starting point was that, you know, when we talk about related party, we're looking at a shareholding of more than 50%. All right, that comes within who are related parties. So in year of assessment 2020, they changed that law and they reduced that shareholding percentage. So from 50%, now it's just 20%. Okay, actually there's a little typo here. It is at least 20%. It's not more than, okay, it's 20 or more. All right, so here entity A holds say 20% of entity B. All right, and can we have click the rest of the slide? Yeah, and all of it. Yeah. Yeah, okay. So what happens now is that the shareholding control is now reduced to just 20%. All right. And there are some additional conditions that one looks at. One, whether the business operation, in my example, company B, whether they are dependent on the intellectual property provided by company A. All right. If the answer is yes, then both become related parties, okay, or associated persons as far as our transfer pricing rules are concerned. All right. Or another scenario, company B's business activity are specified by company A. So company A gets to dictate who company B buys from, who they sell to, and you know what sort of services they get to provide, right? And the pricing for which company B charge for its services is also influenced by company A. All right, so if that's the case, also comes within definition of control. Now the last one is the most easy to meet, okay? Is where one or more members of the board of director, the board of company B is appointed by company A. All right, so that is usually the easiest one to meet. Company A just need to appoint one member to the board of company B, and with the shareholding of at least 20%, that makes company A and company B associated or related parties. Okay, so this came into effect year of assessment 2020. So that would mean for Labuan companies, your financial year end 2019. All right, next. So here, and perhaps you can just click and get the whole slide out in the interest of time. Okay, so here we'll have a little example, you know, that looks at a controlled transaction, right? So here we have a Labuan leasing company, all right? So as you know, a Labuan leasing company has certain substance requirements to meet. So, you know, up to, if it's a single company, up to 10 leasing companies, you just need 2 full-time employees as headcount, right? And also for each of those Labuan leasing companies, you need 100,000 annual operating expenditure in Labuan. Now, if you meet those substance requirements, then the tax on chargeable profits is just 3%. Okay, and of course, if you don't meet substance requirement, then it goes back to 24%, still under the Labuan Income Tax Act. All right, so from a transfer pricing perspective, here company X is the party that transacts with Labuan Co, right? And company X also holds 100% shares of Labuan Co. Now, because of that, they become related parties. And that lease transaction for the use of the leased asset, right? Now that lease payment must meet the arm's length requirement. Okay, so here Labuan Co will then need to consider how do you prove that that lease payment meets the arm's length requirement under your your section 17, okay, of the Labuan Income Tax Act. All right. Now next slide. Okay, so I've always said that you know, the basis, and in my example, I have a Labuan leasing company. And I said that Labuan leasing company now needs to prove that that lease rental payments that you are charging to your related company meets the arm's length requirement, right? And the law provides that if the charging is too low, then the Director General or the Inland Revenue, they can come and revise that number, right? And change it, right? So that uplift it to become an arm's length price, okay? And that means your chargeable profit will be greater. So how do you then prove that these lease charges meet the arm's length requirement, right? So we are looking at having a transfer pricing document set up to give basis to support the arm's length position. Okay, so the one that IRB accepts, the Inland Revenue accepts, okay, is really this thing called a transfer pricing document. All right. So in this document, there's a whole lot of items. I think there's not enough time to go through with you, but just a couple of pointers, I think, here for Labuan companies, right? One, of course, you have substance. So we have the functional assets and risk analysis or FAR analysis that you see on your bottom left corner, right? So a FAR analysis sets out, you know, when a Labuan company has employees, and here, remember, we have minimum 2 headcount for a Labuan leasing co, what do you do, right? What is the role and involvement of the Labuan company in this whole lease transaction, right? And that will determine how much price that transaction, right? Because the idea is that the more you do, the more complicated it is, the more you do, the more risk you take, then obviously the pricing needs to be greater, okay? And your profit margin will also be more, all right? So in transfer pricing, we have 5 methods to determine what is an arm's length price, right? And again, for a leasing transaction, maybe we want to look at a CAP method, which is a comparable and controlled price method, which simply means that, you know, if it's a Labuan leasing company and we're looking at, say, oil and gas assets, right? And say it's a rig, it's an oil and gas rig, then the question is, how do I make sure that, you know, the price, the leasing for that rig meets the arm's length requirement? A benchmarking is required, right? So it's very important to be able to have third-party benchmarking, all right? So you need to undertake a third-party benchmarking to determine what sort of pricing is the market price, okay, is the arm's length price, all right? In Malaysia, as I mentioned, for the rest of Malaysia, we have very, very detailed transfer pricing rules, right? We have transfer pricing guidelines, and then we have transfer pricing rules. In Labuan, we actually don't have that. Okay, so we just have to fall back on in some respect to the Malaysian transfer pricing guidelines to give some understanding of how to get this transfer pricing document ready in order to prove that those transactions meet the arm's length requirement. All right, maybe we can have the next slide. Okay, and then just let me quickly wrap it up. So in terms of penalty provision, so I see how Labuan has developed from a transfer pricing perspective compared to the rest of Malaysia, right? So as I mentioned, the rest of Malaysia is very, very advanced. And we have all sorts of penalty provision for, you know, failure to submit transfer pricing documents on time, to various transfer pricing surcharges, you know, if there is an adjustment on those pricing, right? In Labuan, the Labuan legislation is always playing catch up. Okay, we will see the change maybe in another couple of years, or maybe in the next budget, we will see that change, right? So it's always playing catch up. So for now, the Labuan legislation sets out that there's only penalty for so-called false declaration, right? So when a Labuan company were to either willfully or negligently make an incorrect or false statutory declaration, then there are penalties not exceeding 1 million ringgit if convicted, right? And also an imprisonment not exceeding 3 years, right? So this is a very broad kind of penalty applicable for everything else. So it is expected that over time, they will refine this penalty to be in line with all the penalty provisions relating to transfer pricing that is applicable for the rest of Malaysia, right? I will also mention one thing before I end the session is that, you know, Labuan, we've seen so many changes. And as tax professionals, you know, sometimes we even find it hard to keep track of all these Labuan changes, right? And my personal view is that often changes are made in a very haphazard way. It's not been properly thought through, and it causes confusion to taxpayers, right? So Labuan companies, you know, they raise so many questions, and it's clear that people don't understand what exactly is happening, right? So just to share with you, just a few days ago, I think just a couple of days ago, there is a new Labuan regulation on the substance requirement that has just been released, right? So what that substance regulation is doing is basically pulling together all the previous Gazette orders on the earlier substance requirements for Labuan companies. Remember, there were a few batches, and putting it together as one complete substance regulation for people to rely on. Now, the main change here is relating to those companies where in 2019, you were providing certain services. So those services could be accounting, backroom support services, maybe even legal, and other processing services, right? So in 2019, the Inland Revenue came out with a set of guidelines to say that if you were providing those services, you were entitled to the 3% preferential rate, right? The 3% tax rate, right? But unfortunately, that was not gazetted. So then they reversed the position to say that these types of companies providing these types of services, they are still not viewed as Labuan trading activities and therefore subject to tax under the Income Tax Act, right? So that caused even more unhappiness and confusion. So today that position has been rectified. So these regulations take retrospective effect back to 1st January 2019, right? So companies which were in that category, please feel free to contact us to see what can be done for taxes that have been paid under the Income Tax Act. All right, so like what Dr. Veerinder mentioned, very much it is an evolving space, and with all these changes to the OECD requirements and so forth, it continues to evolve, right? So watch this space. Our slides, I can see a lot of requests for slides, and the slides are effective as of today, right? So tomorrow, I can't guarantee that the slides are still applicable. All right, so back to you, Waiman. Thank you for your attention. Thank you very much.
I think what Moili was talking about, the changes vis-a-vis Labuan, yes, can get confusing. Let's admit it that, but I believe that it just, the flip side to that is that this shows the commitment of the Malaysian government, the revenue, and Labuan FSA towards really building a jurisdiction that people can use efficiently and effectively. And I think the release of that Gazette order 2 days ago, well, late in the evening 2 days ago, is testament to that. And it's a collective and collaborative effort. There are still, as Dr. V was talking about, some questions that have arisen based on this Gazette order, some very simple questions, but more or less, I think we're there. The situation with regards to other trading entities, or OTE as we call it in our lingo, is now, I think, probably as done as dusted as possible. What's interesting to note, actually, and this is my personal opinion, obviously I caveat everything I say by saying I market develop for the jurisdiction, but I am not a tax professional, unlike you guys. What's interesting to note is that under that new list, the Gazette order, there's an entire slew of activities that's now allowed, right? There are some questions with regards to whether consultancies can be deemed agency or not, and all the rest of it. Yes, and I'm sure we'll get further clarification on that. However, what's interesting to note is that it's two-pronged, right? So based on this OTE, this new list, my sentiment, my personal take on it is that obviously there's an opportunity now for Labuan service providers to expand what they currently do for the Labuan ecosystem. And I go back to that original statement that I made earlier about the Director General being quoted as saying that by the end of the year, we're going to have 900 licensed entities. What are your thoughts about this Gazette order, Moili? And how do you think Labuan, both Labuan users and Labuan TCSPs and Labuan advisory and intermediaries can really benefit from these changes?
Yeah, for sure. I think earlier what caught a lot of taxpayers by surprise is that although they had substance, they had a full team located in Labuan, but suddenly they were kind of bounced off, and they couldn't get that 3% rate. And then there was such a shock to the system to be told that, hey, actually your tax bill is 24%, right? So I agree with you. It's good that the authorities have listened and acted upon it, right? So I totally agree with you that, they have listened and they have put it in order, so to speak, right? So I think definitely Labuan companies, if it is still a useful destination where there is clear substance and you have a team in Labuan providing this kind of so-called backroom support services.
Yeah, and hopefully that will grow even further with this new listing of support services and other kind of roles that are now available to Labuan companies very clearly. And there's one thing that I would really like to highlight, and Dr. V, maybe you can disagree, but as far as I know, based on your extensive experience vis-a-vis my limited understanding, is it or is it not true that Labuan is probably the only jurisdiction that I at least have heard of, that there is a clear, unequivocal list in order to meet your substance requirements, in order to enjoy your preferential tax scheme? And is it or is it not true that Labuan is probably the only jurisdiction where you then have a fallback rate in order to kind of limit your tax liability then, as it were?
Yeah, thank you, Farah. I think you're right that we are the only jurisdiction which has a fallback rate. If it's not 3 or 0, it could be back to 24% if you don't comply. So that is worked in favor of pushing Labuan to the fore as being a jurisdiction which has got very, what should we say, strenuous requirements, solid requirements. The other aspect is obviously perhaps even surprising. For example, that we talked about, no other jurisdiction which is vying for the business that Labuan vies for and encourages has got the transfer pricing regulations in place as well. So I think in that sense, we are far above the rest. And therefore, that adds to the attraction of Labuan if you're looking at a jurisdiction which has got solid substance requirements and follows the rules and so on. And part of the reason why we are doing that is because Labuan is part of Malaysia. So the Malaysian rules are the fallback. And therefore that allows us to really work hand in hand to ensure that we can still make Labuan attractive and yet don't run foul of any of these international bodies, requirements and rules to have substance. So yes, so I agree with you. I think to me that's the positive, very positive aspect of Labuan now, compared to earlier when you first started. Perception was that we are only a 0 or 3% tax rate, not much of substance. You can flow through. That has all been cleared up, right? So we therefore believe that this is therefore a very viable jurisdiction, depending on cost structures, depending on your computations of the cost you incur, the compliance cost you'll incur, and the tax effect. And you can actually see that in the end of the day, Labuan may still be a beneficial option for many of our listeners or viewers at this particular webinar as well.
Yeah, I mean, one of the things that when OECD came out with the substance requirements, I mean, I think a lot of Labuan intermediaries were sat there going, this is the end, this is the end. But actually, from a market development point of view, our agency has seen exponential growth. And that is because there's a natural flight to quality. Yeah. And Labuan is a quality gold standard jurisdiction. So, that really has worked in our favor. It's, it's a confluence of everything working out for us to be able to grow how we've grown the last 3-4 years, in spite of what people were concerned about with regards to taxation and stuff.
I mean,
now, sorry.
I mean, Farah, just a quick point is the perceptions by many was that the OECD or the Forum for Harmful Tax Practices will come down in a harder manner but really in the end they can't. There are too many of international offshore financial centers to sort of attempt to shut down if they are not, like the BVIs and all that. So I think this was a very productive way of looking at substance requirements and still allowing businesses to function and grow. And then common reporting system, sharing of information and all that. And that's the way, I believe, administratively to iron out whatever misperceptions. So in that sense, that has given us in Labuan better viability and to build ourselves up from the earlier perceptions that all the substance requirements will be the end of IOFCs. And those were what many articles did appear in terms of the future of IOFCs as well in the foreign media and so on. So it worked out very well.
Yeah, no, it did completely work out very well. And actually the fact that we are part of Malaysia is fundamental towards this success. And being part of Malaysia, you know, I'm cognizant of the time, and I'm cognizant of people starting to drop. But I wanted to just you know, address this issue, which actually Catherine was talking about when we were discussing preparing for the panel. She said this is going to be the hot question with regards to foreign source income. And how can Malaysian entities use a Labuan entity or a Labuan entity in order to try and manage potential foreign source income taxation onshore in Malaysia?
Yeah, maybe a quick one in the interest of time as well. This foreign source income exemption is one of the most exciting things that have happened compared to the many years that I've been in tax system, and it's created a lot of hoo-ha. But yes, if assuming that the Ministry of Finance doesn't listen to all the noise going on and sticks to its guns to say this foreign source income exemption that Malaysia has in its income tax act is now gone.
Yeah.
What does that mean? That means that all foreign income that is remitted will now be taxable. And this is very important from Labuan's point of view. Let's say dividend income. Dividend income that you get from all your subsidiaries overseas.
Yeah.
Now coming into Malaysia, to where Malaysia is a holding company, you're now going to be taxed. Of course, you may get credits if you have suffered foreign tax overseas. Compare that with Labuan. Using Labuan as a holding structure to hold all your overseas investments, and therefore getting all this income coming in. If you're just a holding entity, assuming you meet the substance requirements, there's actually a zero tax situation in Labuan. So actually, if this goes on in the context of Malaysia, the minister sticks to his budget proposals, actually it makes Labuan more attractive, right? But I dare say that attractiveness may be short-lived, because they may then have changes coming in Labuan in a year's time. But nevertheless, that's the main attraction that actually Labuan can leverage on if this carries on, right? Otherwise, to me, at the end of the day, the Labuan structures in terms of tax rates are very workable, very, very beneficial. And I just wanted to allude to the fact that when you look at Pillar 1 and Pillar 2 and these things that only the very large multinational are subject to, I think many of them may not find the need to use Labuan because they're already very well established and they use other jurisdictions. And so the thing is, all those MNCs which are below that particular category actually may find usage of IOFC still to be beneficial. Willing to go through the substance requirements, willing to do structure it commercially, it's still viable. So I think there's still great news in the sense of Labuan could be an option to whatever is happening in Malaysia. But even if that doesn't come through, you still have existing benefits that already exist, as Catherine has pointed out, and so on and so forth. So I think it's still good, very good to go.
No, yeah, I mean, I think in Catherine's presentation, if I may speak, she also spoke about the captive insurance proposition. And really, this is a unique thing about Labuan, which I really wanted to talk about as well, is the fact that we are an organically grown jurisdiction. So we started servicing the Malaysian corporate scene. And from that, we've grown internationally. So, you know, because of that, what has happened is that we have a very strong base, and that strong base really should continue to be beneficial to Malaysian entities as much as international entities. I mean, if you look at our insurance business now, from 60% being domestic, it's now almost 70% foreign. So, you know, we need, and the team and I will continue to talk to Malaysian entities to try and make sure that, you know, they come up to speed with all the changes in Labuan. So all in all, we've overdone. There are a whole list of questions here, which I'm sure Team Tricor will come back to you because we have your contact details, and Team Tricor will come back to you with very specific answers to your questions. At the end of the day, I think what I'd like to leave everyone with is the idea that whilst there is a lot of conversation, maybe sometimes even debate as to the future of international financial centers, but if you look at international financial centers or wholesale financial intermediation centers, as I like to call them, as the plumbing of global finance, you'll see that there is a need for IFCs, and there is nothing wrong, right, for large conglomerates like PLCs in Malaysia to really avail themselves to the benefits of these wholesale financial intermediation centers. This has been going on since the First World War, even before the First World War, everywhere in the world. Maybe in Asia, we need to really, pick up and embrace this and not necessarily look at it as something where you go somewhere to hide. Because as you can see from the presentations of all our panelists today, it's very above board, number one. Number two, it is globally accepted. And I just like to really emphasize that. And please get in touch with Team Tricor with any further questions you may have. We have, I believe, a questionnaire. Please fill it up. Let us know whether you'd like to hear from us again, whether you'd like a specific session from Team Tricor, for example, or something more generic. But last but not least, thank you, Tricor, for agreeing to partner with us on this. We look forward to the next edition, and thank you very much for spending your afternoon with us. We hope you've learned something more about Labuan, and come and join us as we grow out of Malaysia into Asia. Thank you very much.